Hey there, this is Adam from Exactly, and in this video we're just going to show you how a lender's serviceability calculator works, so how they determine whether or not you can afford to borrow the amount that you're looking for. So this one is for Genworth. Genworth's actually a lender's mortgage insurer, so they're not the lender, they're the insurer. However, very relevant because there's only two mortgage insurers in Australia pretty much, and they're the biggest. And all the banks have got their own version of something like this, very similar. So this is almost the exact process that every bank goes through. It's just that they'll use different figures and different credit policies to go through it. So we've got, in this scenario, $350,000 loan over 30 years, principal and interest repayments against a purchase property of $400,000. So the loan to value ratio is 87.5%, and the interest rate on the loan is 4%, and the assessment rate is 7.3. So just to explain here, so we're putting the actual rate on the loan here, but the lenders will have their own assessment rate. If I show you something, if I put 1% there, it doesn't go below 7.3, so this is Genworth's floor rate. That's the lowest rate that they'll use as your assessment rate. If I change that to 7, see how it goes up. So there's at least a 2.25% margin for Genworth. All banks are pretty much the same. Won't necessarily be 2.25. They'll all have their own margin, and they'll all have their own floor rate, which if they're a deposit-taking institution, which all the banks are, it has to be no lower than 7 for that assessment rate. However, most banks will have somewhere between 7, 7.25, 7.75, something around there as the minimum assessment rate. So anyway, so we've done that little assessment rate to death, and we'll move on. So we've got an applicant here, Johnny. He's single. He's got no dependents. He lives in North Sydney. He's on 80,000 gross per year, and that's a net income of 61,081. So the calculator works out how much tax Johnny has to pay. His net income 61,081. Then we move down to commitments. This is the minimum living costs that Genworth will use. We actually have to get the borrower's living costs as well. So let's just assume that we've spoken to Johnny. We've gone through his scenario, and he's $25,000 a year in living costs. That overrides the 18,000 because it's higher. If it was less than 18, we'd be using the 18,832, but because I put 25 in, that's the amount that's going to be used. We've got a credit card for Johnny. We've put a $5,000 credit card limit in at 3% per month. That's what the Genworth will assume as being the monthly repayment, as 3% of the credit limit, which works out to be $1,800 per year. Now, pretty much all banks will be 3%, 2.5%, something like that, as the figure that they use. That might not be your minimum repayment, but that's the amount that the lender will use. So just above there, we've got the monthly repayments on the proposed loan. As you may recall, $350,000, back down here. So at the assessment rate, the monthly repayment $23.99, which is $28,794 per year. Then on the side here, we've just got, on the actual rate of 4%, $1,671 per month. So that's how much the monthly repayments are actually going to be, but that's not the amount that is used in the affordability or serviceability assessment. So if we add that $28,794 and the $1,800, we get $35,994. So that's the total commitments. Just above that, total net income $61,081. So then what we do is we come down here, net disposable income. So we go back up there, 61,081. Then we less the living costs. They're kind of off the side to the commitments. Living costs, 25,000 we've used. So we take 25,000 off the 61,081. We've got a net disposable income of 36,081. And that net disposable income, 36,081, is 1.171 times the total commitment. So that 36,081 needs to be at least a ratio of 1 to 1. So it needs to be at least as big as that total commitments. and that's assuming the assessment rate repayments. You can see underneath here, this amount here, that's on the actual rate here. So if we were to use that amount instead of that amount, that's the maximum loan. However, they don't use that. They're just using that as a bit of a demonstration. This is the maximum loan in this scenario here. So if you wanted to check that, you could go 36,081 divided by 3594. So there we go. So that's how they get that. So that's a pass. So Johnny's going to get his loan. So Johnny's PAYG, so we put that in before. Now let's have a quick look and see what happens with a self-employed borrower. So let's assume Johnny's now self-employed. We've removed his income there. He's self-employed, so we're going to enter his income. So 80 to 85% of lenders want 2 years worth of business income. So let's put the 2 years in here. Let's say Johnny's current year is 140. So once they take the 2 years, they generally average them out. But we're going to say Johnny's previous year was a bit crappier. It was down about 50. And no interest or any other add-backs. So almost all of the lenders that want the 2 years figures, so as I said, 80-85% want 2 years, nearly all of them will average the 2 years out. So 140 plus 50 divided by 2 doesn't come to 60. And the reason that is that if there's more than if there is a significant difference between these two, they will not take more than 120% of the lower of the 2 years, because it's a little bit unstable. You know, you've had a big increase. So if Johnny needed more than $60,000 to service his loan, he's going to have to choose a bank that's going to go off just the current year and not average him out. So he's only going to be able to have a choice from about 15% of lenders, which doesn't mean he's going to get a worse loan. In fact, it certainly doesn't mean that. It just means he's got less options to choose from. So let's go back to the calculator and see how this looks at 60,000. 60,000. Okay, so his net income 47,981. His net ratio is 0.75 to 1. So he's going to fail. He's not going to get a loan with a lender that is going to average his 2 years worth of income out. So let's just assume that we've got a lender that will take just the 1 year. I'll put that in because this calculator requires us to put 2 years. But if we were having a lender that was only looking at the most recent years, they're going to take 140. Exact same client, exact same tax returns. It's just that they're only looking at the most recent year. And we come down here, and all of a sudden, you can lend 860,000 with that lender. So again, let's just go back, 865,000. $257,000. So it's amazing how much difference that can make. So anyway, that's all we wanted to show you today, just how the actual serviceability calculators works, and hopefully that gave you a good insight. Oh, one last thing, please hit subscribe or opt in or click the link below or beside or above the video. Thanks for watching.